And right now, folks, as we do each and every Tuesday and Thursday at 30 past the hour, we're going to talk to our man Tim Ord. You can reach Tim at his website every trading day, folks, ord-oracle.com. There you see the gentleman right there. And don't forget, at TFNN.com, folks, you hit the services tab, a couple of great webinars, The Secret Science of Market Tops, How to Identify Market Tops with our man Tim Ord, and 6 secret ratios every trader should know. Check those out as well. And we talk about some of those ratios as we talk. Tim Ord, good afternoon.
Good afternoon. So, I'm a garbage market. It kind of just creeping up here. We actually were long for a while. We got out for pretty much a break even. And I thought I'd end up with a sell signal, and I still may. But anyhow, yesterday we had a trend close at 1.38. Today, last time I checked, around 1.4, maybe actually a little bit higher, and that shows panic in the market. And and even though the market's rallying, I've listed all the times going back to this is about June. And I listed all the ticks and trend readings going forward here that reach panic levels. So you really don't want to short when there's panic in the market. So it's kind of and actually we're rallying and the trend and ticks are showing up. So it's a little bit unusual. There's a little gap right here, and we're running into that gap right now. And the volume, I'm kind of watching the volume. The volume's that day right there. And so this is earlier in the day. We're not going to reach that volume, which looks like about 75 million shares on that day. We're not going to reach that. A lot of times you test gaps in a lighter volume. They're kind of resistance, but you're going to have a trend in bullish territory. So I'm thinking at best we're going to flip sideways. I don't think we're going to keep rallying. Here's another indicator, is kind of reason why I don't think we will. This is the SPX tilt ratio, and the bottom window is the SPX. And it was bullish into mid-August because both markets were making higher highs. The SPX tilt ratio was making higher highs as the SPX was making a higher high. And normally a bearish divergence shows up when the SPX tilt ratio makes a lower high while the SPs make a higher high. Well, we did that going into the recent high of first part of September there. But the ratio made a lower high. You can kind of see it over here a little bit better. You can tell it there. We made a little bit lower high, and the SPs made a higher high. And right now, I'm kind of watching this ratio. Yesterday, we hit a new low, while the S&Ps were way off their low. And currently, we're pretty much unchanged from yesterday on the ratio, and the S&Ps are back up into this gap area. So that's a bearish divergence, but which one's correct? You kind of wait and see. Let's get down to another one here. This is the VIX ratio. Middle window is the SPY VIX. Bottom window is the S&Ps. And if you notice over that last high in late August, the ratio made a lower high, and the S&Ps made a higher high. And that's usually, when those versions start showing up. So we got two of them. You got this one, which is the SPX tilt ratio, and you got the VIX SPY VIX ratio showing bearish divergence. But on chart number 1, you got panic as the market's pushing higher. So a lot of cross currents. So I'm glad I'm not long or short. The market will give us, final, I think, answer a lot of times on Fridays. So we'll see how that turns out, because they make you wait until Fridays, and you have to sweat that trade over the weekend. And I think that may happen here. And I may not get a signal at all. And this market just may, out of nowhere fall, kind of fall down, come right back at you. So I hate to say, but I think we're in a trading range until October. I think this month is garbage, not too much higher than where we are. I think at some point, I don't know if this month or next month, but we're going to see 6,100 is basically the February highs. I think at some point we're going to go down there, because the pattern I think we're drawing here is a rising wedge pattern, and they're characterized by falling volume as the market works higher. I think ultimately, I don't know where the exact top is. We may actually touch a minor new high before it falls back down. But I think this 6,200 area is going to be a target. So top windows of the S&P Wealth tilt ratio, you can actually see it there a lot easier. Obviously, that's making lower highs as the S&P is making higher highs. So not a, it's kind of a don't know. So call it what it is. But I'm kind of leaning short, but I don't want to shorten up a market that's panic on the way up. So
yeah,
and we don't really have volume driving up. So
no. Hey, tomorrow might be a big Friday, right? We got a certain event going on. I know you're not, you follow the charts. I love it, man. But when you say that, of course, in the back of my head, I say, hey, man, if we're looking for a Friday tomorrow, we could, we'll see. But yeah, obviously with
we can see it'd be a worthwhile trade. There's really no fear in the market. You get these big rallies going, you need fear. But the 10-day trend, I didn't show that, but that's one I watched pretty carefully. Yesterday was 0.92. Anything around 0.9 and lower, it usually appears near highs. We're 0.92, and as the market kind of rallied here, the trend closed over the last couple of days increased. So probably today it's going to be a little bit higher than that. But ideally, to really get these big rallies going, you need that 10-day trend to be up around 1.2 or higher. And so I'm thinking to get the rally that I think is going to come, probably starting in October, that'll run into to year end. That 10-day trend will get to 1.2 or if not higher to push enough energy in the market to push this market higher. But right now with the reading around probably 0.4 today or 0.94 today in that vicinity, it really doesn't have the volume, I think, because the volume is going to be quite light today compared to the previous down. So I don't think we're going to take off to the upside. So
okay.
But we're about ready to break here.
We sure are. We're going to talk some gold when we come back?
Yeah, we're going to talk about some gold. So I hate to nothing to really say about the S&Ps. That I'm looking for a high in this vicinity. So, but I don't have a sales signal, so I have to wait.
Hey, that's what the charts are saying, right? That's what they're saying, and I'm sure we got a lot of listeners waiting for gold. Gold's all-time highs yesterday, 36.40 on the futures. We're trading right now 36.06. We're coming back with Tim. We're going to talk a little gold, folks. We'll be right back. Welcome back, folks. We got the S&Ps. You're approaching record highs right now. Futures up 46 points at 65.03. We got non-farm payrolls tomorrow. We got gold at $3,605 an ounce. And we're talking to our man Tim Moore. Don't forget, folks, you can reach Tim at his website, ord-oracle.com, as well as a couple great webinars at TFNN.com. All right, Tim, let's dig into some gold. What are we looking at for gold?
All right, this is really the big picture. This is the monthly XAU gold. It goes back to 1984. And I kind of watched this chart over the years, basically for 1984 to 2008. The market has bounced around in the trading range from basically, 0.18 to 0.35. It did that. So when it got up to 0.35, it was at a high side, and it come back down, and then it bounced around for a number of years. Then it broke below that level in 2008, and it went sideways there for about 2 years. Went sideways here for about 6 years. Another kind of a sideways pattern. So it's a pattern within a pattern of a bigger pattern. And what I want to point out, this market, the ratio-wise, hadn't really done anything since 2014, about 11 years now. It's just gone sideways. It bounced around, it looked like about 0.05 to 0.08, give or take. And I think we're going to bust out of this trading range. Either we're going to bust out to the upside or we're going to bust out to the downside. To me, it would be kind of unrealistic to suggest we bust down to the downside because it's darn cheap. I actually have this ratio going back to 2009. It's never been this cheap. Or not 2000. I think it was 1909. It's over 100 years. Whenever it actually got down around 0.10 over that 100-year time span, it was actually a decent buy signal for kind of a long-term trade to the upside. We're actually half that. We hit, close to .05. I don't know what the exact number is, but we're way down historically, going back over 100 years, that this has been extremely cheap for gold stocks. So I'm thinking we're going to break out here to the upside and break away from this trend. Time will tell. We broke this trend line. Matter of fact, me and your dad talked about breaking that trend line, and actually we did. And now we're starting to go back up. Are we going to break above the previous highs here of 108? I think we probably will. So we'll see. This is the big picture. There's a lot of conjecture here, but going back 100 years, anything below point 0.1 was a buy. We hit 0.05 over a 100-year period. You would think this was going to break to the upside. We'll see if that happens or not. I'll keep an eye on it. But once this breaks to the upside, it would imply a multi-year rally in this ratio. I think a minimum target would be this 0.17. Around 0.108, which is basically the previous lows of going back here. So that would mean a gigantic rally in the gold stocks. So let's kind of look at the short-term picture. That's the big picture. It doesn't give a buy or sell signal, just something I'm looking at that possibly may be happening right now. Because, a lot of times third time's up. So this is one time up here. It didn't make it. This is second time up here. We're now doing it the third time. A lot of times you break out on the third time. So technical analysis says we will, time will tell if we do or not. So let's look at this, kind of what's going on near term. This chart goes back to 2014, and the bottom window is the GDX advanced decline with an 18-day average. This is GDX advanced decline for the stocks in GDX. So there's around 30 or 35 stocks, I think, in GDX. So it's around that number. Next window up is the 18-day average of the up-down volume for GDX. So it measures the up and down volume in the stocks in GDX along with the advanced decline. So it's pretty much there's all the technical analysis you need to see to get a good idea what GDX may do in the future. But anyhow, I marked the times when both those ratios, in other words, there was extremely strong advanced decline and extremely strong up-down volume when those two indicators get above 40. And those are the ones I got the red lines marked here. So each time that happened, both those indicators got above 40. So the recent one was, I forgot what date it was, but it was over the last couple of weeks. We got above 4. I think it was last week. One was like 44 and the other one was 39.48. Not close enough. But yeah, we did get above. Now we're kind of backing away. Well, previous times when that happened, 2016 rally started and went on another 6 months. Next one happened in 2019. So that's 3 years later. So these signals are kind of rare. The market went up for another 3 months. And then one in 2020. This is the COVID crash. Then you had a rally. Then the ratio hit it. Then you went up another, looks like, I guess it was 6 months. And this one failed. It just kind of picked a top and it kind of went down, then finally get going to the upside. So what's this one going to do? Well, here's what it's doing right now. This is the short-term view of what the market is doing. So these are momentum indicators on advanced decline. The bottom, not the bottom window, but the second window up is the GDX cumulative advanced decline. And the next window up above that is the cumulative up-down volume. So these two indicators trend up when GDX is going up because advanced decline is expanding and the volume is expanding. And that's what happens in uptrends. So I marked the times in blue when both those indicators are above the mid-Bollinger Band. So I put a Bollinger Band on this, and this is the weekly GDX. So it measures, it kind of measures momentum. The last time it gave a buy signal, looks like, early 2025, this year, gave a buy signal and still in a buy signal. As long as those two indicators stay above the mid-Bollinger Band, the pink areas are times when both indicators fell below the mid-Bollinger Band, and the blue areas are when the indicator is above the mid-Bollinger Band. And right now, this price is currently, and we're a long ways. There's the mid Bollinger Band right there for that one. And, we're a long ways above it.
Yeah.
So for this indicator, there's no sell signal here. I did go short here a couple of weeks ago. I covered that short for a loss, and I should have paid more attention to this momentum indicator. But right now, this indicator is not even bending down. A lot of times you'll get short-term divergences, like I point out one here. Here the GDX made higher highs. Both those indicators made, well, at least that one did, made a lower high. And right now there's no divergence at all. It's just still going pretty much strongly up. So according to this indicator, you should be long until it falls below the mid Bollinger Band, and you'll get some sort of a correction then. So when will that happen? If at some point it will, but right now I don't see any signs of this of the gold stocks actually weakening. So we'll see.
Pretty remarkable.
Trends
hey,
up.
Yeah, that's the trends up, and I say pretty remarkable only because I pull up the GDX, and we're at $33 to start the year. We're at $64 right now. But boy, it's got momentum, man, as you say. Well, Tim, great stuff as always, man. We appreciate the good information. And gold, 3,600, right? Quite a number. Folks, check them out, ord-oracle.com. And Tim, have a great day, great weekend. We look forward to talking to you on Tuesday.
All right, thanks a lot.
Thanks so much. Folks, we're coming right back. S&P's up by 46. One more segment. Don't go away, folks.